Welcome everyone. Thanks for coming. All right, so I'm going to start, as I mentioned in a couple of the emails in the last presentation, a couple of communications lately. We're going to start doing these little monthly updates. We're going to start doing some more updates in general, as I've been saying for some time. But at the very least, we want to start doing a monthly little catch up, little get together, cover any client questions that have come through, talk about any major developments in terms of Investor Unity, its service offerings, the markets, anything that might meaningfully impact the services, the MSP performance specifically, and also just do a little bit of a recap of the MSP performance and so forth. So just a bit of a general catch up at the very least, and I am going to do my absolute best to keep these sessions as brief as possible, even say 10 to 20 minutes, just depending upon what needs to be discussed and covered, as I am somewhat well known for going over schedule and getting a little bit carried away with market developments and everything else. So, with that in mind, let's take a quick look at the markets as we jump across there. Okay, so we do have a couple of little open positions on the euro franc at the moment, but that is somewhat irrelevant. They're not overly important to this presentation. Now, the main sort of recap we just want to give is in terms of the long term performance of the major markets and major indices, the macro level type picture that might be affecting individual strategies or individual positions, perhaps to some sort of meaningful extent. And there's not a great deal to cover. I mean, we basically have the most major markets consolidating in a volatile fashion below their highs. So this is the 2 year period. This is the January. End of 2020, and I mean that's basically what we have going on around the world at the moment. If we flick across to the S&P 500, which is the major US benchmark, of course, the last time we did a major or a more sort of in-depth analysis of the major markets was around this point here, and the prediction as such at that point was that we were looking to see some major volatility, or that was the most probable outlook in any case, that kind of volatility. So that certainly has come to play. In terms of the macro picture, there's not a great deal has changed, believe it or not. We've just basically seen a lot of the things that everyone's been talking about for some time start to come to pass, in that the money printing, the quantitative easing slash stimulus measures that have been going on for some time now, all the cheap money, all the ultra low interest rates, the race to zero from central banks around the world that have been in place for several years, has starting to have its almost inevitable negative effects of inflation. And those who are sort of the more respectable in the industry will tell you that the inflation is caused as soon as you pump more money into the system. It's just a case of how you measure it and how it's felt by the everyday consumer or everyday citizens. So we're starting to see that come into effect, of course, and that, of course, has just forced central banks around the world to reconsider their interest rate positions, and essentially, ladies and gentlemen, everything else is, in terms of the markets, is really a sub story within that. Everything comes down to how interest rate decisions, whether to continue to raise, or, even when an interest rate decision is announced. The market is always looking for indications within that announcement. So they'll look beyond the initial announcement to what the central bank governor or head of the Federal Reserve, especially, of course, says in their comments following the announcements, because the market is not just looking for the number itself, but with any sort of major announcement, the market is looking for indications of how long that's going to continue. And so there's going to be stories operating within that framework, within that context, of course. Wars, major company developments, major technological developments is another major one. But everything is really a sub story within that main context of interest rate increases, how much they will increase by, and for how long. At this stage in the cycle, with the picture looking a little bit clearer, the market is starting to look a little bit more closely towards trying to find clarity as to when the cycle is going to end. And so that's basically that in terms of the markets. There's not a great deal to discuss in terms of the macro picture and what the outlook may be. In terms of equity investments, it's not a major focus of ours, to say the least, and certainly not at this point, and probably not for the foreseeable future. The MSP strategy continues to do well, continues to be solid and consistent in the face of the market switching from very bearish over a certain period to very bullish over another period with a lot of volatility in between, due to the non-directional nature of MSP and its primarily short-term focus. These kind of developments don't really need to be factored into the approach or the outlook in any major uh, sense. And when I just for those unfamiliar, when I say the non-directional, that just means that we're taking long and short positions. We're trying to capture opportunities on both sides of the market, both rising and falling markets, and not just in equities, but primarily or effectively exclusively currencies. Again, at least for the foreseeable future. But for investors out there that are looking for a little bit more clarity and perspective, the position remains the same. Interest rates are the story. Everything else is a sub story around that, and predominantly the excuse me. In bottom line terms, quantitative terms, strictly logical terms, you may say, the risk reward at these levels, being so close to all time highs, just isn't there. It just isn't on the long side or on the buy side. So from a short, medium term perspective, the opportunity really is to the downside, and there's probably going to be a lot of great opportunities for the traders and swing traders to take advantage of the most likely scenario again, which is just continued volatility within these ranges. And then, so that's just a very basic technical analysis there, looking at trend lines and price structure and so forth. You can see here that this major directional trend line there, which is much more of a measurement than a prediction or a projection. But in terms of projections, you can see here that it does extend out for several years, and by that sort of base level framework indication, you might say, you can see that there's the real potential for several more years of um, consolidation slash volatile choppiness within these types of ranges there. Now that may not be good to hear or even easy to imagine, but please do remember that nothing is unique, especially about this point in history. The market has gone through long periods of consolidation before. The sector that the market at the moment is heavily driven by the tech sectors and technological developments as a whole. And the Nasdaq, which of course is tech heavy to say the least, has in the past, um, just a decade or so ago, gone through long periods of consolidation. And by long I mean 15 years, 15 years of consolidation. And the thing to understand is that when markets expand their ranges like so, Let's make that a bit clearer. When markets expand their ranges like so, as you can see here, it doesn't just increase exponentially as such in terms of price and percentage movements, but it also increases in terms of time. So every major, well, typically, major periods of consolidation, retracement, rebalancing, effectively processing all of the excess liquidity or liquidity that's out there in the markets at the moment, in the economy at the moment, is could well take longer than what might be considered a historical norm or beyond historical uh, precedent. So that's that one there, and I've got to stop myself because I'm going to start carrying on about the markets a little bit too much. Let's take a little bit of a recap on performance and get into the main sort of part of the presentation. And this is a bit of a follow up from the previous end of financial year presentation that I run. And the main thing to understand beyond the performance recap of MSP itself is that there's a new variation of MSP, which is called MSP V, and MSP V, with the V standing for variable risk, is what we really want to talk about and explain in a little bit more depth. And so I will just jump across to the website now to make that to try to show you where you can see the information for yourself and go through it in a bit more detail. So just for those that are unfamiliar with the site perhaps or have just joined us and or if any from the main homepage or from any page, in fact, your navigation button there is your friend. It will take you very quickly to all of the key pages, and the one in question there, the members homepage being a key one to access presentations and other educational type stuff. But the MSP performance review, as you can imagine, gives you an overview of MSP and its performance. So just note that we're now using a lot of these tab functions on the website. So you can see there's the main tab, overview and FAQs, basic stuff there. Most of you existing clients, of course, will be pretty familiar with all of this. Now, the performance overview, however, does conveniently and appropriately named give you an overview of the performance. Now, there's two tabs here, and the MSP V is what we're going to be talking about to give a clearer explanation. So, just up front, anybody who is already on a custom risk setting, that means they're not on the standard risk setting, is unaffected by the new implementation or offering of MSPV. So their settings will stay the same, but MSPV will actually become the new default for those that are on the default, and that means that anyone that hasn't requested custom risk multiples. And so what does that mean? Well, great question. Let's talk about that. I just want to try to give a bit of an overview there. So, okay. So the key thing to understand, jumping over to the board now to give you a bit of a blackboard lesson. Okay, so we're all used to looking at charts. Well, there's in the investment world, there's something called an equity curve. An equity curve is just a chart of your account balance. So no investment realistically goes up in a perfectly straight line. There's going to be increases and decreases in the value of your investment effectively as things change over time. So the equity curve is something that you need to consider, because it's not just a measure of performance, but it's also a measure of risk, and more specifically, from an individual's perspective, it's a measure of risk tolerance. Okay, so everybody has their own risk tolerances due to their personality type, where they are in their life, what they're doing with their other investments, and how much they have allocated to any particular investment. Everybody's a little bit different, which is why we always have to use terms like conservative and risky and moderate as subjective terms. They are almost by definition subjective in the financial world. They're anything but one size fits all concepts. So if we look at the standard, let's just say the standard performance of MSP is like so. That would just be the default setting. Now, if you wanted a higher risk approach, for example, you would have, let's say, a multiplier, what we call a risk multiplier, or a performance slash risk multiplier, because performance and risk are the same thing. Let's say you had a performance multiplier of 2 applied to your account, which is done at setup or just by sending me an email. Then you get the same strategy, the same buys and sells, the same entry price, the same exit price, but the quantity, the per trade quantity changes. And at a 2x multiple, a 2 times performance slash risk multiple, as you can imagine, it doubles, goes up by 2. And so you get the same strategy, same performance effectively, but you get double the profit and double the losses. Okay, as we can see there. So what that means is that you might you obviously get higher performance, but you also get these larger swings through these periods here. Okay, so that means that and these periods are called drawdown, by the way. So it's just when your account has decreased or declined from its peak, in the exact same way that a stock would or a managed fund would. There's no real difference at all in term across product types or asset types. It's the same concept for all. And so if the standard approach delivers, let's say a 15% return over a 12-month period, then you would expect the 2x approach to deliver 30%. Nice and easy. Okay. Let me move this up a bit. Okay, 30% over the same period, but obviously, or perhaps not obviously, but you would, in any case, expect that to come at a cost, because nothing is perfect in this world, and there's no such thing as a free lunch. The enhanced performance comes at a rougher ride. You don't get the smooth ride that you got with the standard 15% return. So if this drawdown here, for example, was say let's say 7%, which is actually about right, 7%, then at 2x you would expect your drawdown there to be 15%. Okay. So that's the way it works, and this one here is based upon a 2x multiple. Okay, so double the performance, double the risk, and risk as measured in terms of the portfolio volatility. Okay, the swings. So it's all up to you, of course. Again, it's personal tolerance. It's how much of your overall portfolio you have invested in this particular strategy and just sort of personal preference in terms of how smooth of a ride you want to where you're going. So that is the purpose of displaying or these different versions that we see on the website, like so. Just zoom in a bit. So MSP standard is just the standard approach. It's the default out of the box type 1, and that has been running in its current iteration since we changed our preferred broker 2 years ago, just over 2 years ago, in fact. And it really was developed and put on offer to give people an alternative, a serious alternative to the mainstream managed funds that most people just plant their money in and hope for the best. And so obviously that's a fine approach. It's if you're buying quality companies and if you're reasonably well diversified, and as long as you're prepared to be patient when patience is required, it's a generally fine approach. The trouble, of course, is when markets do go through major corrections or major periods of consolidation. Other things happen around the world, of course, and markets just go through these long periods of delivering little to no returns to passive investors. They don't even really reward them for their patience unless they're prepared to be very, very patient. And a lot of people, especially if they're at or in retirement, don't really want to be sitting around for 10 to 15 years for things to sort themselves out. And so MSP was just developed as an alternative for that. It's non-directional. It doesn't depend upon market conditions, but it was intended to be conservative, really very conservative. And what that means is that the performance here that you can see over the last 2 years. This page, by the way, once again, is these figures are automatically updated. So these automatically pull from the master account, the master MSP portfolio account. And so the returns are there. As you can see, one of the major things is it's just steady and consistent throughout any kind of market turmoil or volatile consolidation, whatever you want to call it. It's just steady as she goes, and just doesn't really worry about major shifts in market sentiment or the broader macro outlook swinging from bullish to bearish or whatever it is. It's just pulling in the returns quite consistently. Now, to understand these figures here, these lines, this is the equity curve that I showed on the board there in a more realistic fashion, obviously. But the two lines is that the blue line is the increase in account value based upon closed profits, closed trades. Okay, so that's the main sort of consistent one there. There's also the red line, which is the value in the account changing while trades are open, while you still have open trades. So you can see there are dips when there's some of the existing positions are slightly in the red, and due to the nature of the strategy and that it's generally effective in what it sets out to achieve, the open losses recover reasonably quickly, and the whole thing just sort of continues on its merry way. Okay, so that red line is in fact the one that you want to pay the most attention to in terms of, once again, determining how smooth of a ride that you're willing to tolerate. Now, the key thing is, and the key there's two key reasons for the implementation or the new offering of MSPV. One is that for most people who are willing to take their traditional equities portfolio or their traditional investment portfolio and diversify it into something that's quote unquote alternative like this, they already have a reasonably high, not irresponsible, but they have a reasonably high risk tolerance to begin with for this type of investment. Um, and so MSP standard has actually turned out to be too stable, more stable than than anticipated, too conservative, basically, for most people's appetites. Nonetheless, we do have a lot of investors that are genuinely very conservative. So we're going to keep that there, but we're going to offer the variable risk approach, which is a more of a moderate uh, offering in terms of the performance swings, account equity swings, more of a moderate uh, uh, type service risk profile in order to generate better returns for clients, higher returns, in fact. And so when I say that this MSP standard is conservative, it really is very conservative. I mean, a lot of people are quite impressed by the performance anyway, because it's outperforming the equity markets with a high degree of consistency, essentially little to no exposure to potential market crashes or other calamitous type things within the market, and also just the fact that it's closing out profits consistently, so that people can use it for income generation should they wish to. And so, in terms of it suiting its aim of outperforming traditional the off the shelf type approach, it certainly succeeded in that. Um, but these drawdowns that you see here, this one being the largest, mid to late last year, possibly October last year, if I'm not mistaken. It was on Australian dollar Kiwi. This was just over 7%. Okay, so that's really very low in terms of even in terms of the equity markets, which can easily draw down 15%. The little COVID spike down on the ASX was some 40%. We had similar drawdown figures of spiking down 40% or so on the US markets at around the same period. 35 to 40% is a fairly typical decline when markets go bearish and go bearish reasonably suddenly. And so a 7% decline in the value of your investment is really pretty tame by anyone's standards. Again, it's highly subjective, and it's not a one size fits all type thing. But 7%, if you compare it to major markets and the things that most people are invested in, is very, very, very low. Despite that, the returns have been good, but we can do better for the sake of taking a little bit more risk. And again, risk just means, in this context, means larger swings. So that's the main reason for the implementation of MSPV. Now, the other thing to understand is that these variations that you see here, that I gave the example of before, 1x, which is the standard, just default 1x, and 2x are just examples. There's also 1.5, for example, that would, as you can imagine, be in between 1 and 2. Okay, there's also 1.7, 1.5, 2.5, 2.7. You can have basically any multiplier that you want. It's completely up to you. Now, the way I invest in these strategies myself, as you can imagine, being the one that's running the allocations and everything else and monitoring the markets. So I invest in these in myself, and from time to time I will adjust this multiplier on my own accounts. Okay, the 1.5, 2x. I might switch it from 1.5 to 3.5 or whatever it is, according to performance and the current exposure, the current market conditions, whatever the case may be. Now, clients don't want to do that. They don't want to be thinking about it and implementing it and monitoring and adjusting it on an ongoing basis. So the V that you see there in MSP V is variable, which actually means that the default MSPV runs at an adjustable risk level. So just like I've explained, as market conditions change and risk considerations change, I will adjust to some extent that risk multiplier. So you still get that same base strategy, but just with a performance multiplier added to it. But unlike the standard risk multiplier that we've seen here, that's been in place for 2 years, the MSPV now offers the benefit of that risk multiplier being modified for you within a typical range on an ongoing basis. Okay, now when I say typical range, it's usually 1.5 to 3 times risk multiple. Okay, so now in terms of looking at what that could be, the MSP, this tab here actually shows MSPV, and this is where we get confusing. It actually shows MSPV at a 2x multiple. Okay, so the reason these two versions or performance metrics are showed on the side is that I wanted to give people sort of a either end of the spectrum type perspective. Okay, so you can be more risk assertive than this if you wish, and you could even be more conservative than this if you wish. But these two will give you a pretty good idea of either end of the spectrum or thereabouts in terms of performance history and performance expectations. And so this version here has been running at between typically between 3.5, and even up to just over 5 times risk multiple. Okay, again on a varying basis according to the general confidence in the system and the broader market conditions, effectively. Okay, so I'll cover these figures here briefly, but as you can see here, the total return is considerably higher. Monthly return there is really quite substantial. These are all net of fees, by the way. This one is not net of fees because of the way it works with the master system, but this one here, as a variation of MSP, actually runs like a client account and shows net of fees results, net of cost results. And the drawdown at this period here, which is the same, just to try to paint the picture again, the same drawdown on the same trades, but just multiplied. This one here was a little bit over 30%. Okay, so you have to be, again, getting back to this idea of, how smooth do you want your journey to be? That's what you would need to be taking into consideration if you are looking to achieve this kind of return. You'd have to tolerate, at least historically speaking, this 30% drawdown here. Now, this is open trade drawdown, by the way, so it's not like we're taking a string of losing trades in a row. The strategy simply held on to the positions in expectation of a recovery, and that recovery lasted, in this case, it might have been, I think it was about 2 months, perhaps a little bit less. Okay, I think it might have, I'll have to check the figures, but that might have been closer to 6 weeks or so on that one. Okay, so you have to take that into consideration. Now, I know this is getting confusing because we're talking about variable risk versions and then multipliers of the variable risk version. But the new default setting which is what people need to understand. Please let me know if you want this covered in more detail. I'm happy to go through it with you individually. But in basic terms, this is the 2x version of MSPV. So the new standard will be MSPV running without 2x, which means that your performance projections will just be half of these. Okay, so based upon historical expectations, you've got, what is that there, 1.9% monthly return, and some 78%, 78.45% in fact, over a 2-year period. And for that, your ride smoothness, so to speak, your equity drawdown tolerance running on the standard version would have been about 15%. Okay, so that standard version that we now have, which is MSPV, not MSPV2X, you have to request MSPV2X or 1.5X or 3X. 3X is getting a little bit extreme, but you would have to request a multiplier of 2X on your MSPV. But that MSPV standard model is to put it more so in line with a slightly non-traditional, higher performance seeking equities portfolio. Okay, in terms of risk, not in terms of performance, because it's expected, at least based upon past performance, to significantly outperform an equities portfolio, especially on a longer term basis and with its consistency, etc. But that's the sort of benchmark that you would use it for, which puts it in line with most people's, just to explain the business thinking behind this, the client-centric thinking. It puts it in line with most clients' expectations in terms of diversifying, as I mentioned before, diversifying part of their mainstream portfolio into a somewhat quote-unquote alternative type investment. That 15% drawdown tolerance with a higher degree of consistency and a significantly higher performance potential is very much in line with those kind of expectations. Okay, so that's MSPV. That's and this is the figures here for MSPV running at a 2x multiple, and this is just the standard model, which is by all standards very conservative and very stable. Okay, I think I hope I explained that reasonably well. That's all we have for tonight's presentation. So we'll finish up there. If you have any questions, please, by all means, send them through. Put them on the chat. I'll stay on chat for a little bit if you want to put the questions through on chat now. Otherwise, please do email them to me. We'll cover them in the next session, or I'll send you a little video, or I'll create a little video that can be shared with the rest of the clients. Whatever the case may be, by all means, reach out so we can make this all nice and clear for you. But other than that, thanks very much for coming along. Wish you successful trading and investing as always, and bye for now.